Another predictor of recessions, Eurodollar Futures. In my video on the yield curve, I briefly mentioned the Eurodollar Futures market. Now I'm going to explain what it is and what it's telling us right now. But the first thing you need to know is that this has nothing to do with the exchange rate between euros and dollars. It's a totally different thing. The futures are just contracts that allow you to lock in a price that you're going to need to pay or receive before you pay or receive it. Eurodollars are loans and deposits of dollars outside the US financial system. The Eurodollar market is about 70 years old, and it got the prefix Euro because most of the activity in this market has historically been done by London banks. So you put those two together and you get Eurodollar Futures, a contract allowing you to lock in the price at which you will borrow or lend Eurodollars. And what is the price of borrowing or lending Eurodollars? Well, the price of any type of money is an interest rate, and in the 1970s, the interest rate that came to define the Eurodollar market was LIBOR, the London Interbank Offered Rate. As of 2020, about $213 trillion of financial contracts across the world are linked to the LIBOR rate. Eurodollar futures are actively traded from less than a month to expiration all the way out to several years. You can also think of them as a bet on the future LIBOR rate. Every contract has an expiration date and an interest rate that fluctuates with buying and selling activity the way that any price does. And that gives us another curve, like the Treasury yield curve, that relates interest rates and time. Here's what it looked like in December 2021 and December 2022. Notice the inverted shape in December 2022. Now, this may still seem complex, but we can actually read this in plain English, and here's how. In December of 2021, the rate for the December 2023 contract was 1.525%. So that means if we're a financial institution and we know that we're going to need to borrow or lend at LIBOR in December 2023, the rate that we could lock in at that time was 1.525%. A year later, the rate on the December 2023 contract is 4.595%. So that means if we know we're going to need to borrow or lend at LIBOR in December 2023, the rate that we can lock in now is 4.595%. The biggest risk to Eurodollar market participants is what the Fed is going to do with its policy rate, and therefore the shape of the curve tells us about the market's expectations for rate hikes and rate cuts in the future. Here's why. LIBOR is historically the short-term interest rate for dollars across the world, and the Fed controls the Fed funds rate, a key overnight interest rate for dollars within the US banking system. These two rates track each other closely. If the Fed is going to raise Fed funds, then LIBOR is going to follow. So now you actually know enough to understand why the curve is inverted. In December of 2021, the Fed told the world that it was going to be raising rates. Financial institutions needed to lock in low interest rates for the couple of years ahead, so they sold the shorter-dated Eurodollar futures, and that pushed the shorter-dated contract rates up. They also sold longer-dated contracts, which pushed those rates up, but not enough to move the long end of the curve nearly as much as the short end. What that means is that there is more money betting on rate cuts from 2023 to 2024 than there is betting on constant or rising interest rates during that time. And that pushes the shorter-term contract rates up higher than the longer rates, which is what creates the inversion. And since the Fed usually cuts when the economy sucks, this inversion predicts recession. Inversion in the Eurodollar futures curve has predicted every recession since its humble beginnings in the 1980s. As always, thank you for your time, and I'll see you in the next video. Take care.